Well, shares of Tencent, they're trading higher this morning after announcing its video game developer Riot Games is laying off about 11% of its staff. Tencent following in the footsteps of dozens of other companies like Amazon and Alphabet, making job cuts in the new year. In a Goldman Sachs note out this week, the firm suggesting that tech layoffs are not concerning and that the labor market is normalizing to pre-pandemic levels. With what these layoffs mean for the broader labor market, Yahoo Finance reporter Josh Schaefer is here. Josh, this was one of our themes last week once we got even more of those cuts that started to come to light. Labor market in limbo. So what is Goldman saying here?
Yeah, Brad. So you talk about labor market in limbo, and then in that same week, we had jobless claims hit their lowest level since September of 2022, right? And weekly jobless claims, if you dig deep into the economic community, you'll get varying thoughts on how accurate those are, but we look for overall trends here, right? And I think Goldman had two key graphs I want to point out in this note. The first one is those jobless claims that they were highlighting, and also not just jobless claims, but overall layoff mentions. So they highlighted in that you can see jobless claims and layoff references that's in the actual jobless claims report. There's more than just the number that comes with that, are actually very low. That's your dark purple line there. And so overall, you're seeing these numbers, if we just look at the trend, right, are about 2019 levels. Like we're talking 200,000 people applying for these on average about a week. And then really the other important graph here is not only is that what we're seeing, but also when you take a look at unemployed workers, they're still getting jobs. And that's an important part when we talk about the labor market here. So I reached out to a couple other economists and sort of got their thoughts on if these headlines matter overall. And I thought it was interesting. Brett Ryan over at Deutsche Bank, their team still has a recession call. They think that the labor market's going to slow down. But he said things like this aren't really quite what you're looking for. You're looking for actual layoff data to pick up, and we just haven't seen it yet. At some point, you need to see it in order for the labor market to actually be slowing down.
And Josh, not to put you on the spot, but in terms of when they are expecting to see that, or the material weakness that maybe they are expecting to see in the labor market, given that recession call, can you put that into context for us and compare that maybe to what Goldman is saying? Because it sounds like Goldman overall is still very optimistic, relatively speaking, on what the labor market trends still look like today.
So it comes back to, remember our discussion about why the recession never came in 23, right? And it was a lot of those lagging impacts of the Fed policy that we never saw happen. So one way it could come would be basically if the Fed doesn't cut in March and say maybe the Fed doesn't cut in May. Now we're talking about restrictive policy for longer than people thought. And then at some point, companies who are paying higher borrowing costs are going to have to find a new way to get capital, right? So then they might finally cut jobs. We haven't seen that happen yet. That has not been part of this post-Fed rate hiking cycle that we've seen. But if the Fed stays higher for longer, and by longer I mean significantly longer than we're looking at right now, companies might have to change the strategy a little bit.
All right, Josh, thanks for tracking this update and the sentiment right now around the labor market here. We'll continue to keep a close eye on that.